What exactly is a hedge fund, and why do billionaires, pension funds, and wealthy investors trust them with billions of dollars? In this in-depth documentary, you'll learn how hedge funds work, where they came from, how managers make money, the strategies they use, why some become legends while others collapse, and what everyday investors can learn from them. Whether you're interested in investing, finance, or simply understanding how money moves around the world, this comprehensive guide will take you from beginner to advanced concepts through engaging stories and real-world examples. The hidden world of hedge funds. Imagine walking into a building with no flashy signs, no advertisements, and no products sitting on shelves. Yet inside that building, billions of dollars are being moved every single day. That is the mysterious world of hedge funds. Unlike banks that hold your savings or mutual funds that are open to the general public, hedge funds are private investment partnerships designed primarily for wealthy individuals, family offices, pension funds, universities, and large institutions. Their goal is simple in theory but incredibly difficult in practice: generate superior returns regardless of whether markets are rising or falling. The story begins in 1949, when Alfred Winslow Jones introduced a revolutionary idea. Instead of simply buying stocks and hoping prices would rise, he combined buying companies he believed would succeed with short-selling companies he believed would fail. This balanced approach reduced overall market risk while allowing skilled analysis to generate profits. Over the decades, hedge funds evolved into one of the most influential forces in global finance, managing trillions of dollars and influencing everything from stock markets to currencies and commodities. Their secrecy, exclusivity, and enormous financial power have made them both admired and criticized. Some have created incredible wealth, while others have caused spectacular collapses. To understand modern finance, one must first understand hedge funds. How hedge funds actually make money. A hedge fund is much more than someone buying and selling stocks. These firms employ teams of economists, mathematicians, data scientists, programmers, industry experts, and experienced traders. They analyze everything from interest rates and inflation to political events, weather patterns, corporate earnings, and even satellite images of parking lots to estimate business performance before official reports are released. Some hedge funds focus on buying undervalued companies, while others specialize in mergers, distressed businesses, currencies, bonds, commodities, or sophisticated computer algorithms that can execute thousands of trades in seconds. Many use leverage, meaning they borrow money to increase potential returns, although this also magnifies losses. Unlike traditional investment funds, hedge funds have enormous flexibility. They can bet that markets will rise, fall, or even stay relatively unchanged depending on the strategy. Their compensation structure usually follows the famous 2 and 20 inches model, around 2% of assets under management plus 20% of investment profits. This creates tremendous incentives for managers to outperform the market, but it also encourages taking calculated risks. Behind every successful hedge fund is disciplined research, strict risk management, and continuous adaptation because financial markets never stop changing. The greatest hedge fund successes and failures. The history of hedge funds is filled with extraordinary victories and painful disasters. Legendary investors transformed relatively small partnerships into firms managing hundreds of billions of dollars through patience, discipline, and exceptional analysis. Some accurately predicted financial crises years before they happen, earning enormous profits while others suffered devastating losses. At the same time, history also reminds us that even brilliant investors can make catastrophic mistakes. The collapse of highly leveraged funds has demonstrated how excessive confidence and borrowed money can destroy years of success within weeks. Every financial crisis has produced stories of hedge funds that either protected investor wealth or lost everything. These successes and failures highlight one important lesson: intelligence alone is never enough. Risk management matters just as much as finding profitable investments. Great hedge fund managers understand probabilities rather than certainty. They know they will occasionally be wrong, so they build portfolios capable of surviving unexpected events. The biggest difference between professionals and amateurs is not avoiding mistakes, it is surviving them. Inside a modern hedge fund. Behind the scenes, a hedge fund resembles a high-performance research laboratory more than a traditional office. Every morning begins with reviewing overnight news from markets around the world. Teams examine economic reports, company announcements, interest rate expectations, geopolitical developments, and trading activity. Analysts build financial models estimating future earnings, while portfolio managers decide where capital should be allocated. Risk managers constantly monitor exposure to ensure losses remain within acceptable limits. Compliance officers make sure regulations are followed. Quantitative researchers develop computer models capable of identifying tiny market inefficiencies. Technology has become one of the industry's greatest competitive advantages, allowing firms to process enormous amounts of information faster than humans ever could. Yet despite advanced algorithms and sophisticated software, investing remains deeply connected to human psychology. Fear, greed, optimism, panic, and overconfidence continue to influence markets every day. Successful hedge funds combine technology with sound judgment, recognizing that markets reflect human behavior as much as mathematical equations. What ordinary investors can learn from hedge funds? Although hedge funds are designed primarily for wealthy investors, the principles behind their success are valuable for everyone. The first lesson is that investing is about managing risk rather than chasing excitement. Diversification protects against unexpected events. Patience consistently outperforms emotional decision-making. Thorough research reduces costly mistakes. Successful investors rarely rely on luck. They build systems, follow disciplined processes, and continuously improve their knowledge. Hedge fund managers spend countless hours studying businesses before investing significant amounts of money. Individual investors can apply the same mindset on a smaller scale by understanding companies, avoiding emotional reactions to daily market fluctuations, and focusing on long-term wealth creation. Perhaps the greatest lesson is humility. Markets are unpredictable, and no one is right all the time. Even the world's best investors experience losses. What separates lasting success from failure is the ability to control risk, remain disciplined, and keep learning. Hedge funds may appear mysterious from the outside, but at their core, they remind us that wealth is built not by gambling, but by making thoughtful decisions repeatedly over many years. Whether managing billions or investing your first $100, the principles of patience, discipline, continuous learning, and intelligent risk management remain timeless.